Have you noticed that if you listen to some financial experts, they are absolutely confident about the future and what you should do about it? These experts may take the form of economists, bankers, brokers, politicians, and of course, internet creators. In fact, especially people on the internet and websites. There is absolutely one thing you can bank on though, and Niels Bohr said it best when he said that prediction is incredibly difficult, especially if it's about the future. In this video, we have a look at some of these predictions and who made them and how to identify an expert worth listening to. I'm Anthony and we're talking money. If you were to take an economics degree, you were taught about economic theory, relationships between variables in an economy like the Phillips curve, for example, that's meant to give the relationship between inflation and unemployment. In fact, my dissertation many moons ago was all about this particular relationship. However, in real life, away from theoretical models, there are simply too many inputs, too many variables in a system, and they all interact and essentially reduces one's predictive power beyond the very short term to practically nil. This was neatly summed up by Friedrich Hayek while accepting the Nobel Prize for Economics. Friedrich Hayek made an astonishing admission while accepting his award. He said not only were economists unsure about their predictions, he noted, but they had a tendency to present their findings with the certainty of the language of science, and this was misleading and may have actually deplorable effects. That said, we can't help ourselves in thinking that we can predict the future, and some people can't wait to tell others. In 2013, Alan Greenspan, the former Federal Reserve Chairman, said, "We really can't forecast all that well, and yet we pretend that we can, but we really can't." And this was from a man who famously warned of irrational exuberance in the American markets in 1996, only to see the market climb threefold over the next 3 years. Greenspan's famous example is dwarfed, however, by some other howlers. Take Irving Fisher, who was a highly regarded economist in the last century, who stated that stock markets had reached a permanently high plateau and to expect stocks to go a good deal higher within a few months. Only within a couple of weeks, in 1929, the market crashed, precipitating the Great Depression, and over half of US banks failed, unemployment reached 30%, and the markets took 25 years to recover to the level at which Irving Fisher made his prediction. Joan Robinson, a prominent Keynesian economist, is another example. In 1964, she predicted that North Korea would continue to thrive and South Korea would degenerate. Closer to home, Richard Branson in 2010 predicted an oil crunch with severe shortages within 5 years, only to see oil prices lower. But if you wanted to have some stock market predictions, how about Abby Cohen, who was the chief strategist at Goldman Sachs, who predicted that the S&P 500 in America would be 1,675 by the end of 2008, but in actual fact, the year ended at below 900. That's quite some way out. Now, these people are people who are absolutely at the top of the game, not someone with uninformed hunches, but are also spectacularly wrong. These are just some examples, but there are many, many more. It turns out that the future is indeed a little bit more tricky to get right. But despite the evidence to the contrary, we still listen to experts like this, and more importantly, we listen to people who are nowhere near as qualified. To perhaps understand why, imagine that you are tossing a coin, for example, and you ask 1 million people to predict heads or tails. Half will be right, half will be wrong. Do it again, and now you have 250,000 people who got the right answer twice. Repeat the exercise another 10 times, and on average, you should have 1,000 people who guessed right all 10 times. Wow, their predictive power must be absolutely amazing. They may even believe that they have some special power. Indeed, ask this group another 5 times, and 30 people will have got the right answer all 15 times. To everyone around these 30 people, they may start to believe that they will correctly predict the 16th coin toss, but you and I know that ask any one of these 30 and they still have a 50-50 chance of being right or wrong. Now that's after 15 coin tosses. The problem with economic experts, they may have been right just purely by chance, only 5 times or maybe 10 times. YouTube experts may have been right only 2 times, 3 times maybe, or maybe none at all. But like our coin toss, the chances that they are right the next time is really just in the lap of the gods. Okay, I know this example is a little bit too simplistic, but you see where I'm coming from. Predictions of stock market crashes, Bitcoin or gold prices, house prices, or the next super share may be right or they may be wrong. The predictive power of those who turn out to be right may be no better than those who got it wrong. It's just that they were right on that throw of the dice. And this goes to some way in explaining why so-called economic experts can get it spectacularly wrong. So who should you listen to? Whose opinions are worth listening to? Well, start with Benjamin Franklin, who said that nothing was more certain than death and taxes. But other than that, anyone who gives certainty to something else is not, in my humble opinion, worth listening to for too long. I personally like people who acknowledge that uncertainty of the future and phrase any predictions in terms of, say, a probability or a chance, such as you have a 1 in 3 chance of getting cancer, or there's a risk of inflation from quantitative easing. In fact, that last one, the risk of inflation from quantitative easing, a lot of people say that that's, inflation follows on from printing money, as it were, which is what quantitative easing is essentially. But there's no certainty that printing money will lead to inflation. If you want proof of this, look no further than here in the UK, where the Bank of England and the Federal Reserve have been buying bonds and injecting money into the economy since 2009, and yet inflation has fallen and remained low and subdued for an extended period of time. Economics is often described as a social science investigating the relationship between individuals and society, but sadly the science bit is largely lacking. The word science implies a particular method of doing things. If you're going to assess the worth of someone who is spouting forecasts or on cryptocurrencies, for example, or share prices, economics, etc., then there should be 2 things that are present before you give any credibility to what they're saying. Firstly, they should have made testable predictions that match the subsequent data, but remember that coin toss story that I mentioned earlier. So the second element is absolutely crucial, is that they base those predictions on some framework of analysis. In other words, it's great that they are right, but show me how they were right. Answer these 2 questions and then I might sit up and listen. Otherwise, we might as well just be talking or taking advice from the bloke down the pub. But whatever logic we apply, why do we listen to so-called experts in the first place? According to their paper entitled The Theory of Trust by, I'm going to get this name wrong, I know, Linda Zagzebski and Joseph Raz, we listen to experts because they are right more than we are. After all, we listen to a doctor or a lawyer because we believe that they know more than we do. In circumstances like this, then your trust in them may well be justified. But one of the reasons that this may not apply to economics, and in particular stock predictions, is that we are trusting an expert to predict the future. And as I keep on banging on about lots of times in these videos, no one, absolutely no one, can predict the future with any degree of certainty. The problem is that as soon as we accept someone as an expert, it becomes rational to believe what they say, regardless of what you may think. This is great if they're right, but can be disastrous if they're wrong. Warren Buffett, perhaps one of our greatest investors of our time, said it perfectly when he said, "Owners of stocks too often let the capricious and often irrational behaviour of their fellow owners to cause them to behave irrationally as well." Because there's so much chatter about markets and economy, interest rates, price behaviour of stocks, etc., some investors believe it's important to listen to pundits. Worse still, important to consider acting upon their comments. Well said, that man. He's absolutely right. Finally, I'll leave you with this little thought. Every time you buy and sell a share because you predict that the future of that stock is either going to go higher or lower, there is someone else on the other side of the trade who is taking exactly the opposite prediction. It makes a market, essentially. Every time 2 people are taking opposite opinions, otherwise our stock market and economies would collapse very quickly. Perhaps a successful economy is dependent on our collective inability to accurately predict the future. As soon as we can predict with certainty, perhaps our future becomes a little uncertain. And there lies, I guess, a paradox. If any of this resonates with you, then hit that subscribe button and we'll talk more money in the next video. Check out my video if you like on how I choose my stocks and criteria that I use. I sort of set out exactly how I do it and the analysis and data that I use. But put in your comments what you think and share your views too. Anyway, I'm Anthony, we're talking money, and until the next one, bye for now.